Welcome to the debate from GiltEdge.uk. Before we begin, this content is for informational purposes only and does not constitute financial advice. Always do your own research and consider seeking independent financial advice before making any investment decisions. Your capital is at risk. Today, The Guardian and The Challenger go head-to-head on "Buy to Let is Dead, is the most expensive lie in British finance. Property still wins." Let's get into it.
Buy to let is dead is the most expensive lie in British finance. A £200,000 property bought in 2016 with a 25% deposit has generated over £130,000 in total returns after mortgage costs. Show me an I.S.A that does that with 50 grand down.
I'll show you one that does it without £14,750 in stamp duty on day one, without a boiler dying on Christmas Eve, and without HMRC taking 40% of your profit because Section 24 turned your mortgage interest from a deduction into a tax credit.
Section 24 hurt, I'm not denying that. But people act like it killed the entire asset class. It didn't. It made higher-rate taxpayers restructure, use a limited company, adjust their portfolio. The yields are still there.
Sure, wrap it in a limited company, and now you're paying corporation tax. You can't access the equity without triggering a benefit-in-kind charge, and your mortgage rate is 0.5% higher. You've just added complexity to chase a worse return.
But you're completely ignoring leverage. That's the unfair advantage nobody talks about. I put down £50,000, I control a £200,000 asset. When that property goes up 20%, I haven't made 20%, I've made 80% on my actual cash invested.
Leverage works both ways. If that property drops 10%, you've lost 40% of your deposit. And unlike equities, you can't sell 5% of your house on a Tuesday afternoon if you need cash. You're locked in.
When has UK residential property ever dropped 10% and stayed down? The long-term trajectory is upward. And you're collecting rent the entire time. 5.5% gross yield on a £200,000 property is real money hitting your account every month.
Gross yield is a fantasy number. Once you subtract £8,250 a year in mortgage interest, maintenance, void periods, letting agent fees, insurance, and landlord certificates, your net yield is closer to 2%. A cash I.S.A beats that right now.
A cash I.S.A at 4% is a temporary sugar rush from high base rates. When rates come down, and they will, that cash I.S.A drops to 2% again. My rental income adjusts upward with inflation. Rents don't fall when base rates drop.
Fine, so let's talk equities then, not cash. £50,000 in a global tracker inside a stocks and shares I.S.A, compounding at the long-run average of 8% nominal, that's completely tax-free. No stamp duty, no Section 24, no tenant who stops paying and takes 6 months to evict.
8% nominal assumes you stay invested through crashes that feel nothing like watching a number go down on paper. In 2020, in 2022, people sold at the bottom. A tenant paying you £900 a month doesn't care about market sentiment.
And a tenant who stops paying rent and knows the eviction process takes 6 months. That's not market sentiment, that's a real zero-income scenario where you're still paying the mortgage. At least I can sell my tracker fund in 48 hours.
Void periods are priced in by any sensible landlord. You budget for 1 month a year empty. The liquidity argument against property only matters if you're financially fragile, and if you're financially fragile, you shouldn't be investing in anything.
That's a nice line, but liquidity isn't just about desperation. It's about opportunity cost. If a better investment appears, I can rotate instantly. You're sitting on a £200,000 illiquid asset that takes 3 months and £5,000 in fees to sell.
I'd argue that illiquidity is actually a feature. It stops people panic selling. The average equity investor underperforms the index by 2 to 3% a year precisely because they tinker and trade. My property just sits there compounding.
That's an argument for the investor's psychology, not for the asset. You could solve that with a direct debit into Vanguard and deleting the app. You don't need to buy a £250,000 illiquid asset to stop yourself from being impulsive.
Fair point on psychology. But here's what equities genuinely can't do: property gives you a physical asset you can improve. I can add a bedroom, Convert a garage, bump the value by £30,000 for a £15,000 spend. Try adding value to a FTSE tracker.
You can also knock through a wall and find asbestos. Every property investor has a renovation success story. Nobody talks about the £12,000 damp course or the planning permission that got rejected. The expected value of DIY alpha is close to zero.
Now you're cherry-picking horror stories. The capital growth numbers are clear. UK house prices have roughly tripled in real terms since 1990. And in the right locations, commuter towns, university cities, the growth has been even stronger.
UK house prices tripled, sure. The FTSE All-Share Total Return Index has done about the same, and the S&P 500 has done 5 times better, all without me fixing a single boiler or filling out a single tax return for rental income.
But you didn't buy the S&P 500 with 4:1 leverage and someone else paying down your debt every month. That's the point people keep missing. The tenant is buying you the asset. By the time the mortgage is paid off, you own it outright.
They're buying you an asset that's been taxed at every stage: stamp duty to buy, income tax on the rent, capital gains when you sell. My I.S.A wrapper means I keep every penny of growth. The gap compounds over decades.
Capital gains on property has a £3,000 annual exemption and you can offset improvement costs. And if you hold multiple properties, you sell one a year. The effective tax rate is much lower than people assume.
Or, and hear me out, you just put it in an I.S.A and the effective tax rate is literally zero. Not lower than you think, zero. On income, on gains, on dividends, forever.
I'll give you that the I.S.A wrapper is powerful. But the £20,000 annual limit means it takes years to deploy serious capital. I can buy a property tomorrow with £50,000 and be generating income next month.
And you'll spend that first month's income on the landlord gas safety certificate. Look, I'm not saying property is worthless, I'm saying in 2026, after Section 24, after the stamp duty surcharge, the risk-adjusted return just doesn't beat a tax-free equity portfolio for most people.
For most people, maybe. But for someone with capital, a decent credit score, and the willingness to manage the asset, property still wins on total return because of leverage. The spreadsheet doesn't capture that properly.
The spreadsheet captures it perfectly, that's why I trust it over gut feeling. £50,000 into a stocks and shares I.S.A, left alone for 20 years at 8% nominal, is £233,000, completely tax-free, with 0 hours of work.
And £50,000 into a leveraged property generating 5.5% gross yield with 3% annual capital growth gives you a paid-off asset worth over £360,000, plus 20 years of rental income. Leverage is the difference, and it always will be.
Until it isn't. My final point is simple. The I.S.A makes you richer per hour of effort, per pound of risk, and per unit of stress, and in 2026, that matters more than raw return on a leveraged bet.
The Guardian, The Challenger, thank you both. What do you think? Let us know in the comments. Read both articles in full at gilt-edge.uk. Thanks for listening to the debate.